Hi everyone. In our previous video, we used present value tables to calculate a bond's issue price. In this video, we'll discuss how to calculate accrued interest payable when the financial reporting period ends between bond interest payment dates. Let's look at an example. On January 1st, 20X1, Lima Company issued 10% 5-year bonds with a face amount of $200,000. The bonds were issued at a price of $185,580. Interest is paid semi-annually on June 30th and December 31st. On the date of issue, the annual market rate of interest was 12%. Lima's fiscal year ends on September 30th. Prepare the journal entries to record the issuance of the bond. Go ahead and prepare that journal entry and start the video again to check your work. Debit cash $185,580 for the cash received. Debit discount on bonds payable $14,420 to balance. And credit bonds payable $200,000. So this bond was issued at a discount, and I would have predicted that it was issued at a discount, even if I didn't know the cash amount that we received was less than the $200,000. And the reason I would predict that it would be a discount is because our contract interest rate is less than the market rate of interest. The $14,420 is the unamortized discount on bonds payable as of the issue date on January 1, 20X1. The carrying value of the bond is the par value minus the unamortized discount. So on the date of issue, the unamortized discount was $185,580. Go ahead and prepare an amortization schedule for the first year of the bond. Don't try to complete all the years, and don't forget to include a line for the September 30th year end. Complete the schedule, and then start the video again when you've finished your work. So here's my amortization schedule. And let me show you where some of these numbers came from. The interest payment is $10,000. Interest is paid on June 30th and December 31st. There was no interest paid on September 30th. The calculation of this $10,000 is the par value of the bond, $200,000, times 1/2 the contract rate, 5%, equals $10,000 cash interest payment. Interest expense at June 30th X1 is the way we've calculated it a number of times before. It's the carrying value of the bond before this interest payment times 1/2 of the market rate of interest, and that's $11,135. We're going to amortize the discount at June 30th by the difference between these two, 1,135. Which means the discount has decreased by $1,135, and it leaves us a carrying value of the bond at 6/30X1 of $186,715. You can check that. $200,000 par value minus the unamortized discount equals $186,715. Now, at June 30th, we need to accrue the interest. Excuse me, I meant September 30th. The interest expense at September 30th is calculated the same way we've always done it. $186,715 carrying value before the interest is paid or accrued times 1/2 of the market interest rate. But that would be for a full 6 months, and we're only accruing for 3 months ended September 30th. So we have to multiply the the 6 months worth of interest, 11,203, times 1/2, or 3 months out of 6 months. So the interest expense to accrue at September 30th is $5,602. Now we do have an amortization of the discount. The amortization of the discount would be the full amount of interest for the 6 months ended December 31st, minus the $10,000 payment we will actually make at December 31st, equals 1,203 amortization of the discount for the 6 months ended December 31st. 1/2 of that, or 3 months out of 6 months, is $602 amortization at September 30th. Reduce the discount balance by the $602, and now the carrying value or amortized cost of the bond is $187,317, which is $200,000 par value minus the unamortized discount. So what do we do at December 31st? Well, at December 31st, we make another payment. So the cash payment is $10,000. We need to calculate the interest expense at December 31st as the other half of the 6 months of interest we calculated up here. 11,203 is 6 months worth of interest for the 6 months ended December 31st, minus the 5,602 we've already recorded as expense, equals 5,601 interest expense for the 3 months ended December 31st. Same with the amortization of the discount. The full amortization for the 6 months is 1,203 minus the 602 that we already amortized at September 30th, leaves $601 to amortize on the discount at December 31st. That brings the discount balance down to $12,082 and the carrying value or amortized cost of the bond up to $187,918. How'd you do on that? There is an example in your textbook that kind of gives you all these calculations, but it never laid it out in a bond amortization schedule, and I thought you might want to see that. I will tell you that there is a calculation that you'll have to do on the exam to calculate accrued interest expense for a financial period that ends between payment dates on the bond. Why don't you go ahead and write the journal entry to accrue this interest expense at September 30th, X1. When you've written the journal entry, start your video again and check your answer. At September 30th, we need to debit interest expense for $5,602. We need to credit discount on bonds payable for $602, and we need to credit interest payable for half, or 3/6 of the bond interest payment that will actually be paid on December 31st. So credit interest payable $5,000. Go ahead and calculate the amount of expense related to this bond that Lima will report in its income statement for the year ended September 30th, X1. Did you calculate $16,737? That's the interest expense at June 30th, X1 of $11,135 plus the $5,602 interest expense accrued at September 30th, X1. Okay, now go ahead and write the journal entry to record the December 31st, X1 interest payment, this interest payment. When you finish, start the video again to check your work. We need to debit interest expense for 5601 and credit bond discount or discount on bonds payable for 601. We also need to debit interest payable for $5,000 and credit cash $10,000. So the journal entry is debit interest expense 5601, debit interest payable $5,000, credit discount on bonds payable $601, and credit cash $10,000. Well, that's all for this video, and that's all for the videos on bonds payable. In the next video, we'll start talking about long-term notes payable. See you next time.